Long-term care insurance, how do we look at this problem? How do we combat it? In our mind, in our opinion, there's really three key ways to insure against or fund long-term care, right? Think about, aging in life, not being able to perform 2 of the 6 activities of daily living, starting to need in-home care, maybe retirement home care. How do you combat that? How do you pay for it? So three key ways. The first one is self-insurance, right? Using your own assets to fund that, pay expenses, maybe buy into a facility. Typically, if you have assets to do that, it's sustainable. The second way that we think about is a long-term care policy, much like car insurance, right? Where you pay a premium, tends to be low, but if you don't use it, you lose it, the premium. So the premium doesn't, or the insurance policy does not carry cash value, and there's no benefit if you don't use it. Similar to car insurance, you pay your premium every year. Hopefully you never get in an accident, but there's no premium, there's no cash value you get back if you don't, right? You're buying into that insurance pool. And then the third way is more of a life insurance type model where you buy into a policy that has a stated death benefit, and also potentially has an accelerated rider to pay for long-term care should you need it. And so in the third scenario, that tends to come when you've got excess assets and you're able to, kind of buy a policy that accumulates, and you're going to get benefit out of it. One way or the other, they're going to use the benefit for long-term care, or alternatively death benefit, or maybe some combination of the two. So those are the three ways we think about, kind of insuring for long-term care. Again, self-insuring, use your own assets, kind of the car insurance version of long-term care, or more permanent life insurance type chassis of a policy. Now, the last thing that I will say is, depending on your situation, there's a lot of factors. In my opinion, a lot of long-term care starts to think more about the next generation than your own. If you can self-insure, right, what happens? You're going to use your portfolio assets until end of life, and then there's just less that goes to the kids. So a lot of times when we talk about long-term care insurance, you want to factor that into the conversation. How important is that to you? Some people say, yes, very important. We want to maximize and get the biggest amount of money possible to our heirs, and others aren't so concerned, with that topic. The other thing that I'll leave you with that I think is kind of important to consider is a premature event. What if in a spousal relationship, one of the two spouses has an event at a young age, and the portfolio needs to pull a ton of cash out of it while the other spouse continues to live healthily for a longer period of time at a premature age? That's another issue, another risk that we like to look at and think about. And so just wanted to give some high-level thoughts. It's been a topic that we've talked a lot about with clients in the past. So hopefully this is helpful for you. We're happy to have this conversation, talk more about what might be the right thing right way to combat this in your circumstance. Thank you.